Welcome to the Deep Dive, the show where we sift through stacks of research and information to bring you those key insights you need. Have you ever had that feeling, that slight dread when a bill arrives or you're facing a big financial choice, and it just feels, overwhelming?
Oh, absolutely. It's a really common feeling.
Yeah, and maybe you've even slipped up, missed a payment, seen that late fee pop up and thought, ugh, how did I let that happen? If that sounds familiar, trust me, you are definitely not alone in feeling that way or even in having that happen.
No, not at all. It's a struggle that hits home for so many people, and unfortunately, it often leads to some pretty costly mistakes down the line. We're talking about a really significant, kind of hidden financial burden here. It quietly drains billions. Literally billions from people's pockets every year.
Billions, wow.
Yeah, to put some actual numbers on it, just think about the scale. Over 20%, 1 in 5 consumer credit accounts get hit with late fees every single quarter.
Every quarter. 1 in 5.
Every 3 months. And this isn't just some abstract number. It adds up fast. Across the board, it's more than $11 billion annually, just in penalty fees.
$11 billion just in late fees.
Exactly. And the pain doesn't stop there. Once an account is past due, it can snowball. You might end up paying higher interest rates on the money you've already borrowed. And maybe even more damaging in the long run, it can really hurt your credit score, sometimes quite badly, impacting your financial options for years to come.
That's a really powerful point. And, for years, the standard approach, especially from policymakers, things like the Card Act back in '09 or state rules on payday lending, the thinking was always fix it with more disclosure.
Right. The idea was, let's simplify the information, make things more transparent, give people all the details about interest rates, how repayment works, the penalty fees.
The assumption being, if people just had this clear information laid out for them, they'd naturally make better choices. It seems logical, doesn't it?
It really does. And the intent behind it, empowering consumers with knowledge about the products, that's absolutely a good goal. But here's the fascinating part, and where things get really interesting. The research on these traditional disclosure methods, it's consistently shown, mixed results at best, often quite underwhelming, actually.
So just giving people the facts wasn't the magic bullet.
Apparently not always. We see study after study where consumers still misunderstand key terms, or even worse, their actual behavior barely changes, even with clearer info. It suggests that while more information sounds good, the sheer complexity of finance, maybe combined with just how our brains process things, means it doesn't always work. People get overwhelmed.
Information overload.
Exactly. They glaze over, the info gets ignored, maybe misinterpreted, or just forgotten when it's actually time to make a decision.
Okay, and this is where our deep dive today really takes a sharp turn, isn't it? Instead of giving people information about financial products, those rates and fees, what if you give them information about themselves, specifically their FICO score?
Precisely. It's a fundamentally different approach to disclosure. You shift the focus from the external product to the internal state, the person's own standing.
And our mission today is to explore this huge field experiment that did exactly that. It showed how giving people this single personalized number, their creditworthiness score, actually changed real financial behavior for hundreds of thousands of student loan borrowers.
Yeah, it's quite remarkable. We're going to unpack not just what happened, but try to understand why it worked, look at the lasting effects, and maybe most importantly, think about what these insights mean for you and how you manage your own finances.
Okay, let's get into it. Let's start this deep dive.
Great. So to really set the scene for this experiment, we need to talk about the FICO score itself and the FICO Score Open Access Program. FICO scores from the Fair Isaac Corporation are just foundational in finance. They're the main tool lenders use to decide whether to give you credit and, crucially, what interest rate you'll pay.
So it's not just some random number.
Not at all. It's a pretty sophisticated calculation based on several key things in your financial history, like your payment history, just paying bills on time. That's a huge chunk, 35% of the score.
Wow, over a third.
Yeah. Then there's how much debt you owe, how long you've had credit, the different types of credit you use, and whether you've been applying for a lot of new credit recently. All these pieces feed into it.
So it's dynamic. It changes based on what you do.
Exactly. It's a snapshot of your credit reliability at a point in time. And this brings us to this big industry movement that really enabled this study. Starting around 2013, there was this major push called the FICO Score Open Access Program to give consumers free access to their own scores.
Ah, right. I remember hearing about that.
Yeah, FICO teamed up with over 100 banks, credit card companies, you name it. The goal was transparency, and the scale was massive. By 2018, it covered something like 250 million consumer accounts in the U.S. People could log into their bank's website usually and just see their score.
That's a huge shift towards transparency.
It really was. And here's a critical detail about that program, super relevant for this study. When you view your FICO score page through these portals, it always comes with 2 reason codes.
Reason codes, what are those exactly?
They're not generic tips. They're specific, personalized explanations for the main factors influencing your score right then. So it might say something like limited credit history if you're new to credit, or maybe account delinquency if you've missed payments.
So it points directly to what's helping or hurting your specific score.
Exactly. It gives you a very direct clue about where to focus if you want to improve. It's actionable feedback.
Okay, so we have the FICO score, widely used, and this open access program making it available, along with these reason codes. That sets the stage perfectly for the experiment itself.
Right, the Sallie Mae field experiment. This thing kicked off in June 2015, and it was big. Over 400,000 student loan borrowers from Sallie Mae participated.
Sallie Mae, the big student loan company.
That's the one. And what makes this study so powerful is the design. They used randomization.
The gold standard, right, show cause and effect.
Absolutely. They randomly put borrowers into different groups. About 90% went into various treatment groups who got the intervention, and the other 10% were the control group who didn't.
And what was the actual intervention for the treatment group? What did they do?
It was actually remarkably simple. They just got quarterly emails, so 4 times a year, reminding them that their updated FICO score was ready to view on the Sallie Mae website. The email also gave clear instructions on how to log in and find it.
So just a reminder, did the email actually show them their score?
No, and that's a really important point for privacy reasons. The email didn't contain any personal info, not even the score itself. It was just a nudge, a prompt saying, hey, your score's updated, log in here to see it. The control group got none of these emails.
Got it. So the study measured the impact of the prompt to look, making people actively engage.
Precisely. It isolated the effect of seeking out the information.
And I see here they even tested different types of emails for a while.
They did. For the first 3 quarters, they tried 3 versions.
Okay, what were they?
First was the baseline message, just a simple, your score is available. Straightforward. Then the economic consequences message. This one really emphasized why the score matters, getting credit cards, car loans, mortgages, even renting an apartment. Tried to make it tangible.
Highlighting the real-world impact.
Exactly. And the third was a social influence message. This one used a bit of peer comparison, saying something like, many of your peers are building strong financial futures by managing credit, a classic nudge technique.
Trying to leverage what others are doing. Interesting.
Yes,
and what happened after those first 3 quarters?
After that initial period, all the treatment groups just got the simple baseline message. This let the researchers see if the initial framing mattered long-term. And there was also this other smaller group, about 37,000 borrowers, called the discontinued sample.
Okay, what was special about them?
They only got the reminder emails for those first 3 quarters, then silence. The email stopped completely.
So that lets you compare ongoing reminders versus just an initial push.
Exactly. It's a really clever design element to understand persistence. Like, do you need constant reminders, or is seeing it once enough to change things?
Very cool. Okay, before we jump into the results, who were these borrowers? What did the average participant look like?
Good question. They were pretty young. Average age was 25, and over half were actually still in school.
So likely newer to managing credit.
Definitely. Their average credit history was only about 6.5 years, and their average starting FICO score was 674.
Which is a bit below the national average, right? Around 700.
That's right, slightly below average. And importantly, about 14% of them had been 30 days or more late on some account in the 6 months before the study started.
So a group that definitely had room for improvement and could potentially benefit from this kind of intervention.
Absolutely. And the crucial thing, because of that random assignment we talked about.
The groups were basically identical at the start.
Exactly. Demographics, baseline credit scores, prior late payments, all balanced across the control and all the different treatment groups. That balance is what gives us confidence that any differences we see later are actually caused by the emails, by the intervention itself. It really isolates the effect.
Okay, the stage is perfectly set. Let's get to the results. Did people actually click the link? Did they look? Because sending an email is one thing.
Right. That's always the first hurdle. Did the message even get through? And the results here are, well, a bit sobering maybe. Only 48% of the people in the treatment groups opened even one of those emails in the first year.
Less than half. Wow.
Yeah, more than half the people prompted never even opened the message. It just highlights how hard it is to cut through the digital clutter, even with important info.
Okay, so email open rates weren't stellar, but did the intervention still manage to get more people to actually view their FICO scores compared to the control group?
Yes, significantly so. Despite the low open rates, it worked. In that first year, 32% of the treatment group viewed their score at least once.
And the control group, how many of them looked without the prompts?
Only about 12% in the control group viewed their score. So the emails caused an 8 percentage point increase in viewing likelihood.
That's a pretty big lift, actually.
Okay.
Nearly tripled the baseline viewing rate among those prompted.
It is. And it shows it wasn't just people switching where they viewed their score. It was genuinely increasing the number of people who engaged with it at all, a net gain in awareness.
Could you see the emails having an immediate effect?
Oh, yeah, very clearly. The data showed big spikes in visits to the FICO score page right in the week after each quarterly email went out. Direct impact. And it wasn't just a one-time look either. People kept viewing. Some were repeat viewers checking updates. Others were first-time viewers who maybe got prompted later on. It had some stickiness.
Okay, so people did look more often because of the prompts. Now for the million-dollar question. Did it actually change their financial behavior? Did it make a difference to their bottom line?
This is where it gets really compelling. The answer is yes. Tangible, measurable improvements. First big one. Fewer late payments. People in the treatment groups were 0.7 percentage points less likely to have an account go 30 days or more past due after 1 year.
0.7 percentage points. How significant is that really?
Well, compared to the control group's rate of late payments, it's about a 4% reduction, which across hundreds of thousands of people starts to add up to a lot fewer late fees being paid, a lot less damage being done, especially considering maybe only half even saw the emails.
Right, if you scale that up, it's meaningful. What about their actual FICO scores? Did those improve too?
They did. The average FICO score for the treatment group members went up by 0.7 points compared to the control group.
Okay, 0.7 points. Help me contextualize that. Is that a lot?
It might sound small, but think about it this way. Getting another year of credit history under your belt might only boost your score by about 1.1 points on average. Or for a major negative event, like getting a bankruptcy removed from your record, that might increase your score by maybe 10 to 15 points.
Ah, okay. So in that context, getting almost a full point just from knowing your score without any other intervention,
Right.
That's actually pretty noteworthy.
It is. It shows that awareness alone, that feedback loop, can drive real improvement in that core metric.
And did this translate into fewer people being classified as higher risk, like fewer subprime borrowers?
Yes, that followed naturally. The intervention cut the proportion of borrowers with a FICO score below 620, that common subprime threshold, by 0.4 percentage points. It's a small shift, but it means moving some people out of that higher risk category, potentially opening up better loan terms or credit opportunities for them later.
Okay, this is already interesting. But you mentioned the researchers dug even deeper. They looked not just at receiving the email, but at the impact on those who actually viewed the score.
Yes, and this is where the effects become truly dramatic. They use statistical methods to estimate the impact specifically on those people who were induced by the email prompt to go and look at their score page.
And what did they find for those individuals?
The impact was massive. Those induced to view were 9 percentage points less likely to have a 30-day late payment.
9 percentage points. That's huge.
It's a really substantial reduction in delinquency. And their FICO scores. They saw an average increase of 8.2 points.
Wow, 8.2 points. That's a significant jump.
It really is. And consequently, their likelihood of being classified as subprime dropped by 5.1 percentage points.
So the act of actually seeing the score, for those prompted to do so, had a much, much larger effect. It confirms that engagement is key.
Absolutely. It's the difference between passively receiving information and actively internalizing it. When people looked, it seems like it really hit home and catalyzed change.
Did the study look beyond just late payments and scores? What about other credit behaviors, like opening new accounts or how much debt they carried?
It did. They found a small but statistically significant increase in the likelihood of treatment group members having any open revolving credit account, like a credit card, and also a slight increase in the number of accounts they held.
So maybe to encourage some responsible credit building.
That's one interpretation. It could be that seeing their score motivated some to establish or carefully expand their credit footprint, which can be positive if managed well.
But did they just rack up more debt? Did their balances go up, or did they max out their cards?
Interestingly, no. The intervention had no significant impact on credit utilization, the percentage of available credit used, or on their total outstanding balances.
Okay, so that suggests the main effect wasn't about taking on more debt or changing spending habits drastically. It was more about managing what they had better, paying on time.
That seems to be the core story, yes. More responsible management, avoiding those costly penalties rather than a big shift in borrowing or spending. Sharper focus on reliability.
What about the long term? Did these effects stick around? You mentioned the study went on for 2 years.
Right, the persistence question. The results were a bit mixed here. The reduction in late payments, that effect was actually strongest around 12 to 15 months into the study. But after that peak, it started to fade. By the end of the 2 years, the difference wasn't statistically significant anymore.
So the improved payment behavior didn't fully stick for everyone.
It seems like maybe the initial vigilance wore off for some over time, but, and this is the really interesting part.
What about the FICO scores?
The increase in FICO scores, that did persist. It remained pretty consistent and statistically significant throughout the entire 2-year period.
Huh. So even if the late payment behavior slipped a bit, the overall credit score benefit held strong.
That's what the data suggests. Maybe the initial improvements created a better foundation, or perhaps just knowing the score had a lasting psychological effect that kept their overall credit health elevated, even if the day-to-day payment diligence wasn't quite as sharp after 2 years.
Fascinating. So like the score itself captured a more durable improvement.
It seems that way.
Okay, so we see these positive effects, especially on FICO scores, persisting. Let's try to unpack the why. What was actually going on in people's heads? What were the mechanisms driving this?
Great question. One of the core ideas the researchers explored is correcting over-optimism.
People thinking they're doing better than they are.
Exactly. It's a well-known cognitive bias. We tend to be overly confident about our own knowledge, our abilities, and yes, even our credit scores. Lots of people overestimate where they stand.
So the intervention acted like a reality check.
That seems to be a big part of it. They did surveys alongside the experiment, and the results were clear. People in the treatment group were 7.1 percentage points more likely to accurately report which range their FICO score fell into.
And how did that accuracy improve?
Here's the key. It was almost entirely driven by a 3.4 percentage point decrease in people overestimating their score. There was basically no change in people underestimating their score.
So it wasn't about boosting egos. It was about bringing overly optimistic perceptions back down to earth.
Precisely. Seeing the actual number served as this crucial personalized feedback. It allowed people to calibrate properly. If you thought your score was 720, but it was actually 650, seeing that 650 is a powerful signal that maybe you need to change something.
It cuts through that self-serving bias.
Yeah.
Makes you face the music.
Right. It aligns perception with reality, enabling more informed decisions and motivating behavior change based on facts, not wishful thinking. It's like stepping on a scale, the number doesn't lie, and it forces you to confront the reality, which can then motivate action.
What about those reason codes that came with the score? Did that specific advice matter much? Things like account delinquency or limited credit history.
That's another good point to investigate. The researchers looked at whether the type of reason code people received made a difference. They did find that the positive effect on reducing late payments was larger for people who got a delinquency reason code. Which makes sense, right? That's very direct, actionable feedback saying you missed payments, that's hurting you.
Very specific. Fix this problem.
Exactly. But importantly, there were still significant improvements. Fewer late payments, higher scores, even for people who didn't get such a specific actionable code like delinquency.
So the score itself, just seeing the number, was still powerful, even without that super specific fix this instruction.
It seems so. The number itself, combined with maybe the general awareness fostered by the reason codes, acted as a strong motivator. It also suggests the intervention wasn't just getting people to fix old delinquencies mentioned in the codes, but was also preventing new ones from happening.
Interesting. So the overall score is a powerful signal in itself. Now, what about the reminders? Was it the constant quarterly emails keeping people on track? Or was it more like a one-time shock that changed behavior permanently?
This is where that discontinued sample gives us such cool insights. Remember, they stopped getting emails after just 3 quarters.
Right. What happened to them? Did they stop looking at their scores?
Their viewing behavior basically fell back down and started tracking the control group almost immediately after the emails stopped. Meanwhile, the main treatment group still getting emails, kept viewing their scores at a much higher rate.
Okay, so the reminders definitely kept people looking at their scores more often. Makes sense.
Yes, confirms reminders boost engagement. But here's the real kicker, the surprising part.
What happened to their financial outcomes? Their late payments and FICO scores.
A year after the emails stopped for the discontinued sample, there was no statistically significant difference in their late payment rates or their FICO scores compared to the main treatment group who kept getting reminders.
Wait, really? So stopping the reminders didn't make their financial behavior worse again?
Not in a way the study could measure. It suggests that the long-term benefits might actually come from a one-time change triggered by that initial viewing of the score.
Like they saw the score, had that aha moment, and then did something concrete.
Exactly. Maybe they finally set up autopay, or got serious about budgeting, or consolidated debt. Some discrete action taken early on, prompted by seeing the score, that then had lasting positive effects without needing constant nudges.
That's a really powerful idea. It's not about nagging people forever, but about triggering a potentially permanent shift in habits or systems.
It points towards that possibility, although there's a slight caveat. The study also found that people who waited longer to view their score for the first time showed less behavioral change.
So timing matters. Getting that initial look sooner is better.
It seems so. It emphasizes the importance of early engagement. Maybe the motivation or the impact of the information is strongest when it's fresh.
Okay, one last piece of the puzzle. The message content. Did it matter how they framed the email? Did the economic consequences or social influence messages work better than the plain baseline one?
You'd think maybe, based on other behavioral science research. But in this case, nope. There was no statistically significant difference in how often people viewed their scores or in their financial outcomes based on which of those 3 email types they received initially.
Seriously?
Yeah.
So the nudges didn't add anything extra?
Not here. It seems the core message, your score is available, here's how to look, was the active ingredient. The simple access to that personalized number was the key driver, not the extra framing about money or peers. The score itself was the nudge.
Wow. And did the intervention make people more financially literate in general? Did they learn more about good versus bad credit habits?
Another interesting finding. No effect there either. Surveys showed most people already knew the basics of good credit behavior before the study even started. The impact wasn't about teaching general financial literacy. It was laser-focused on personal FICO score knowledge, giving them that specific feedback loop on their own performance against those principles they already understood.
It wasn't about general knowledge. It was about personalized, actionable feedback.
Exactly. That seems to be the secret sauce here.
Okay, let's pull all this together. What are the big takeaways from this deep dive?
Well, the headline is pretty clear. A really simple, cheap, and easy-to-scale intervention, just giving people access to their FICO score and nudging them to look, led to significant positive changes in financial behavior. Fewer late payments, higher credit scores across a massive group of people. It really shows the power of personalized feedback.
And it seems the power comes from the FICO score itself, acting as this single clear number.
Absolutely. It's personalized, it's quantifiable, it changes based on your actions, it's dynamic, it lets you track progress, see where you stand, maybe set goals. It's, like you said earlier, a fitness tracker for your finances.
Instead of vague goals like be better with money, you have this concrete number that moves.
Right. It cuts through the complexity and gives you one clear metric to focus on. It seems really well suited for motivating self-correction.
Which makes you wonder, doesn't it? Could we apply this idea elsewhere? Like, imagine an overall health score combining diet, exercise, sleep.
Or an efficiency score for how you manage your time. The principle of having a single, clear, personal, dynamic metric could be incredibly powerful in lots of areas. It taps into our desire for feedback and improvement.
So for you listening, the big so what here is the potential of tools that correct our biases, like that over-optimism, and give us direct, personalized feedback. It really highlights that learning often comes from doing and then seeing the results of your actions, especially when that feedback is clear and relevant to you.
Exactly. It's not just abstract knowledge. It's seeing how your actions impact your score. That real-world experience, prompted by relevant info, is a powerful teacher.
Okay, so before we wrap up, let's leave our listeners with a final thought to chew on. While this study showed really clear benefits in terms of credit data late payments, FICO scores couldn't see everything, right? Like people's income or how much they had in savings.
That's a crucial limitation, yes. We only see the credit report side of the picture.
So it raises this provocative question. When we focus intensely on optimizing one specific measurable thing like a credit score, could there be unintended consequences elsewhere? Could someone become so obsessed with their FICO score that they maybe neglect building up an emergency fund or saving for retirement because those things don't directly move the score in the short term?
It's a really important point. Are we optimizing one metric potentially at the expense of overall financial health, which is much broader and harder to capture in a single number?
Exactly. It's something worth pondering as you navigate your own financial life and think about what metrics truly matter for your long-term well-being. A great topic.